I'd love him to lower interest rates. But other than that, what can I tell you? We had a little talk about it, and I thought it was a very productive talk. He'll be able to tell you at his next meeting, but I will say that he did say the country's doing really well. You know, his term comes up soon. I think he's going to do the right thing. Everybody knows what the right thing is. Even people that believed in, you know, the higher rates, they're all on board. They all want to see the interest rates come down. It's very important.
President Trump there pressuring Fed Chair Jerome Powell on cutting rates, this time in person as he visited the central bank headquarters to inspect renovations. I'm Paul Allen, live from Sydney. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, despite Trump's urging, economists think the Fed will hold rates again next week, and that's helped curbing risk appetite in the markets. Asian stocks set to break their longest winning streak since January. We'll discuss that with JPMorgan global strategist Raisah Rasid, and also get her views on trade deals and negotiations a week out from the Trump tariff deadline. As talks with the US continue, India strikes a free trade deal with the UK. We'll hear from the Commerce Minister and get insights on the practical effects from Elara capital economist Garima Kapoor. Also ahead, fighting continues for a second day along disputed areas of the Thai-Cambodian border. We'll take a look at the root causes of the conflict and get a live update from Bangkok. Also, Liverpool Football Club arrives in Hong Kong to kick off a series of international pre-season matches in Asia. We'll ask the CEO of the English Premier League champions about their big spending on recruitment and their business outlook. Our top story today, President Trump has again pressed Fed Chair Jerome Powell to cut interest rates, this time while taking a tour of renovations at the central bank's Washington headquarters. Trump and Powell traded barbs over the cost of the project, with the president joking that he'd usually fire a project manager overseeing similar cost overruns. Even so, Trump said he doesn't plan to fire the Fed chair.
To do that is a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing.
Do you have a name in mind?
I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
Well, stocks in Asia are slipping, and that's despite US stocks notching fresh records. Avril Hong's there with a closer look. Avril.
Yeah, Paul, U.S. stocks in their winning ways. We saw how out of 19 sessions, they actually clocked 10 fresh records. They've been continuing to bounce from their April lows as trade uncertainty eases. Overnight, we saw tech leading the way as Alphabet's forecast helped to offset concerns sparked by Elon Musk on Tesla's forecast, that gloomy outlook earlier in the week. Asia stocks, as you say, kind of diverging a little. They're snapping their longest winning streak since January. And if you take a look at this chart, maybe they were already due for a breather anyway. You look at the relative strength index, it has been past 80 and at multi-year highs. And I think we can also show you some data out of the US, those jobless claims that fell for a 6th straight week. This is the longest streak since 2022. So that's raised some uncertainties about the Fed's rate cut path. Swap traders pared back some of their bets overnight, and September now sounding a bit premature. Amid all this, we've been also seeing the dollar firming up. It seems to have reasserted its positive relation with short-term yields, while all this is going on in the background as well, Paul.
All right, thanks very much, Avril. For more now, let's get to Raisah Rasid, global market strategist at JPMorgan Asset Management. Raisah, thanks so much for joining us today. I do want to start with the Fed. Of course, there's a meeting next week. Of course, not expecting any change to rates, but you're also not sure that we're going to get any easing in September as well. So what are your expectations around easing for the rest of 2025, and a bet starting to diminish on this idea of 2 cuts?
Yeah, no, thanks very much, Paul, for having me. So when it comes to the Fed, I think to your point, the expectation is that we could look about 1 to 2 cuts later this year. I think there is wisdom to really waiting for more data coming through, as mentioned earlier, the initial jobs data that really is still painting a more constructive labor market picture. And I do think that the Fed is really waiting to see the inflation impact from tariffs, and I do think that there is a lagged effect, and that could come somewhere between the third quarter, fourth quarter of this year. So really waiting on to see that macro impact. Right now, the growth picture is still holding up. So if we look at the manufacturing PMI data, it's still really showing signs that there is still U.S. resiliency. But obviously, when we look at the forward guidance of the PMI data, export orders, etc., that seems to be showing that there could be some payback to that strength that we did see in the first quarter of this year.
Well, of course, data dependency, patience, on hold, these are all trigger words for President Trump. The longer the Fed stays on hold, the more the political pressure on Jay Powell is likely to mount. Is Fed independence something you think about or worry about, particularly once Jay Powell's term comes to an end next year and he is replaced?
Look, I mean, this is something we think about, something we talk about, especially given the headlines that are really coming through of late. But we do think that central bank independence is really going to be the core essence of what is going to be driving monetary policy guidance. But also remember that besides the Federal Reserve Chair, there is a broader FOMC committee as well to also think about. And they do make decisions in concert as well. So we potentially could see some dissent over the course of the next couple of meetings, but we don't really see major policy swings. Again, we are still thinking that inflation, the growth backdrop will really be continuing to be the guiding factor to what the Federal Reserve Committee really does over the next course of the next 6-12 months. But what we do know, we can argue about the timing, whether it's September or December, but what we do know in 12 months forward, we will see a decisive downward shift in long-term interest rate. I think that's what, as long-term investors, what we're concerned about.
Yeah, of course. And, as you point out earlier, Jay Powell's just one person. It is a committee that sets rates. But I just wondered if you could game out the scenario for us. President Trump would like to see lower rates by 3%. So what would happen under those sorts of circumstances to things like asset prices, growth, consumption, and, of course, inflation?
So, I mean, in that scenario, if we do see interest rate come down too quickly, I think the biggest risk is the fact that we could see a resurgence in inflation coming back to the U.S. I think, again, going back to what we said earlier, there is wisdom in waiting to see how the magnitude of that pass-through from tariffs to inflation will really affect the U.S. consumers. I think what the Federal Reserve is concerned by right now, would those inflation expectations be anchored? Because if they're not anchored and it's a really one-shot pass-through, because at the end of the day, tariffs is a consumption tax on the U.S. consumers. If we do not see inflation really anchored, expectations anchored, then we could potentially see the Fed really moving forward. But the cautious stance, what you mentioned earlier, the wait-and-see approach, we do think that there's a lot of credibility in that, and undermining that credibility could really trigger a sell-off in markets of sorts.
Yeah, and, there are encouraging signs on inflation, but obviously the beast not quite tamed yet. But if we take a look at some of the action in U.S. fixed income markets at the moment, we're seeing some signs of potential concerns over stagflation. Is growth something that you're concerned about at all when you run your eye over the U.S. economy?
No, that's definitely something that we're concerned about. I think the baseline view right now, at least for the second half of this year, is one that you do see growth in the U.S. economy running slightly below trend, and that is really due to the tariff impact on consumers, as well as some of that payback to the exports, at least to the activity that we saw in the first quarter of this year. So that's going to likely be a drag on U.S. growth in the second half. But at the same time, looking at the incoming data, still quite strong, but we are still in this period period where we're negotiating a lot of the trade deals. We do think that trade negotiations are very dynamic in nature. So even we do get a deal, it may not be done and dusted as well. So we are living in this realm of uncertainty also. Stagflation obviously is the #1 key risk around that baseline view that we do have, which is why we're telling investors, having kind of building a more resilient portfolio beyond that 60-40 traditional portfolio, really adding some of that private, more defensive assets, whether is it real estate, infrastructure, etc., that could be really provide opportunities for investors at this point in time.
Yeah, I want to unpack some of your allocations in a moment, but first I do want to touch on one other central bank that has been in the news. Obviously, the ECB staying on hold as expected, but in the commentary seems to be setting quite a high bar for any further easing. How likely is it that maybe the easing cycle's, if not over in Europe, almost over?
No, I think it is, to your point, I think it is a toss-up whether they could potentially go once more, or they're basically done. And I think effectively the center of what's really guiding the ECB is really what's going to happen on their trade front. If you just take a step back and think of the macro backdrop in the Eurozone right now, it's still resilient. But the thing is that core inflation will likely undershoot this year as well as next year as well. But at the same time, I do think, as something that the president of the ECB has already mentioned, they are waiting to see how would such negotiations really proceed. I think right now we are getting some optimism around a lower effective tariff deal with the EU. So if that really is the case, then that could at least remove some of that downside risk to growth, and we could potentially see the ECB really remaining on hold. But at the same time, if you are going to see if a tariff rate really rising quite dramatically or uncertainty around that, then I do think that the ECB could have one more cut in them, at least in this entire cutting cycle.
Yeah, to your point on growth, the ECB did note that the economy is holding up pretty well in Europe in this environment of trade uncertainties. So with that in mind, I know you see some value longer term in European assets. So what do you like there?
I mean, defense is something that we've talked about quite extensively, and with the German fiscal push that is about to come through. And bear in mind that when we're looking at the manufacturing data that is really coming through, we are seeing some signs of positivity there even before this fiscal push is really being manifested already. So that is a positive outlook. I think there are opportunities in other sectors, because if you think about that NATO deal that was struck in terms of increasing the defense spending, there's also the additional 1.5% of GDP around the infrastructure to really support this defense spending over the course of 10 years. So if you're thinking about sectors, industrial construction could be something as well. As you mentioned, the macro backdrop is still quite resilient. So as a European consumer, there's some opportunities to unlock there when it comes to the consumer side as well. So there are certain sectors. I think the European equity market is something that active selections become really, really critical.
And I'd like to get your read on US earnings season so far as well. We've seen a pretty good range of beats when it comes to consensus. But to what degree do you think has a weak US dollar helped flatter some of these results?
Yeah, I think if you just consider the S&P 500, a lot of these companies actually do gain some of their revenue sourced outside of the U.S. rather than in the U.S. So the weaker dollar is actually a tailwind to some of the corporate earnings. So it's not all bleak when you think about the U.S. dollar and corporate earnings right now, given the revenue exposure offshore. Now, going back to the earnings, as you mentioned earlier, 80% of the companies so far that have reported have beat expectations. But I think what's really interesting that the second quarter was going to be very critical for us to look at, given this was a slew of the tariff announcements coming through. It was peak tariff uncertainty, but it does seem to be the case that some of these tech giants, for example, are still really able to navigate some of these uncertainty. And also CapEx guidance for next year is still looking quite constructive. So when it comes to US equities in general, we still maintain our view that US equities form that core allocation in your equity portfolio, and really just focusing on the more structural trends around automation and AI, because it does seem to be the case that that will be the main driver of earnings as well as long-term equity returns.
Yeah, I'd like to get your views in terms of Japan as well, which is just, well, notwithstanding today's pullback, had one of its best weeks, if not its best week of the year so far, after that trade deal got signed with the US. So have you been looking at reallocating into Japan at all?
Yeah, I mean, Japan is a place that we've looked at even before the trade deal has been struck. I mean, the trade deal, it just adds that further tailwind, especially around the auto sector. So, I mean, if you just consider Japan on the domestic side to us was always going to benefit from higher consumer purchasing power because wage negotiations have been really constructive. We did see the single increase in wages from the negotiations, and we see very evident in core inflation as well. So there's consumer side sectors those are going to be quite benefiting from, could benefit from such higher wages on the consumer side. On the external side, meanwhile, the decline, at least in the tariff rate in the auto sector, could at least provide some sort of tailwind and at least reduce some uncertainty around it. I mean, we have seen some of these stocks really rally in the last couple of days, but even taking a step behind and just thinking about what was actually really driving our view on Japanese equities, really this corporate governance story, right? Really improving shareholder value, etc. And we do think that this is a structural trend. It is going to take some time for it to really materialize, but it is one of the underpinnings of why we actually do like Japanese equities.
Yeah, and in terms of anticipating some good news on the trade front with Japan, are you taking a similar philosophy towards China at the moment? Because we've already had a few encouraging signs around a US-China deal in terms of rare earths and AI chips as well. So what's your approach to China right now?
So, I mean, obviously, like everyone in the markets, we are waiting to see the outcome of the third round of negotiations next week in Stockholm. But I think the view around Chinese equities remain unchanged. We do want investors to really take that kind of barbell strategy when it comes to offshore and onshore equities. There, to us, at least on the offshore front, you get exposure to some of that growth companies as well. The volatility in equities offshore is slightly lesser than it is onshore. On the onshore equities, the exposure there will give you the sort of opportunity to reap any fiscal support that really come through. And really the high dividend play is really very much still an onshore equities play, right? And if you just consider valuations across both offshore and onshore equities, they're both looking quite favorable vis-a-vis the long-term averages. So again, we do still find conviction in Chinese equities, both on the offshore market as well as the onshore market.
Raisah, just finally, to what degree do you have a sense that markets may be priced to perfection right now? We've seen a pretty big run-up. Would you anticipate a pullback or a stalling at all?
So, I mean, I think pullbacks and drawdowns are par for the course. So if you could see a negative headline, like, you know, something that happened in April, we've lived through it. I think volatility is something that is par for the course. But what we're telling investors is really stay invested. I mean, we've already lived through the month of April. This is really going to be modus operandi going forward as well. So staying invested is going to be key. But really rebalancing some of that portfolio if it's not very balanced already. So within the U.S., kind of looking towards the U.S. value, looking at international equities could be something. And really, if you're income-seeking investor, looking at what we just spoke about in China, where the high dividend story is still very much intact. So really rebalancing portfolios becomes so much more critical in times like this.
All right, Raisah Rasid, Global Market Strategist at JPMorgan Asset Management. Thanks so much for joining us with your analysis and insights today. Still to come on Insight, fighting breaks out for a second day across the Thai-Cambodian border. We'll have an update of that situation next. This is Bloomberg. Thailand's army says border fighting with Cambodia has continued for a second day after Thursday's military clashes killed at least 14 people. We're live to Bangkok in a moment, but first, Bloomberg's Avril Hong has more on the long simmering border dispute.
Thailand and Cambodia's long history of border tensions had largely remained stable since a deadly conflict in 2011. The latest dispute erupted in late May, with troops exchanging gunfire in a disputed border area. One Cambodian soldier was killed. The border standoff continued as diplomatic efforts failed to ease tensions. In mid-June, then Thai Prime Minister Paetongtarn Shinawatra attempted to defuse the situation in a phone call with former Cambodian Prime Minister Hun Sen. Days later, the call was leaked. In it, Paetongtarn appeared to criticize the Thai army. That sparked a sharp rise in nationalist rhetoric in Thailand. Thousands of protesters took to the streets of Bangkok, demanding the Prime Minister's resignation. A Thai court later suspended Paetongtarn, pending an investigation into allegations of ethical misconduct. This week, military operations across disputed border areas escalated rapidly, with reports of F-16s, missiles, and artillery strikes. Each side is blaming the other. Both Thailand and Cambodia have now downgraded bilateral diplomatic relations. Avril Hong, Bloomberg News.
Let's get an update now from our Bangkok bureau reporter, Patpicha Tanaka-Sempipat. So, Patpicha, what's the latest?
Paul, Thai and Cambodian forces clashed early yesterday, and fighting is still ongoing well into the second day across multiple frontiers along the two countries' long shared border. The latest toll from Thailand is that 13 civilians and 1 soldier have been killed, while many other 3 or 4 dozen have been injured, while on the other hand, Cambodia has not yet released any official numbers for casualties or fatalities. This, of course, was a dramatic escalation following incidents where Thai soldiers stepped on landmines twice in a span of 1 week, with Thailand accusing Cambodia of planting mines and Cambodia denying those claims. And this, of course, followed a very long simmering border tension between the two countries since a skirmish in May and the subsequent buildup of troops along the borders, as well as tit-for-tat measures to restrict border movements.
Yeah, and there's implications here as well, aren't there, for Thailand's domestic political scene? What's happening?
Definitely, Paul. The clash now looks set to deepen Thailand's ongoing political crisis, as Prime Minister Paetongtarn Shinawatra is still suspended by the Constitutional Court and could lose her job over allegations of ethical violations over her handling of the border dispute that started in May. If you recall, the call was sparked by a phone. If you recall, the crisis was sparked by a phone call that she had with former Cambodian leader Hun Sen, in which she was trying to defuse tensions, but was heard criticizing the Thai army. Now that call sparked the biggest protest in Bangkok in years last month, and now the same protest group is threatening to rally again this Sunday in order to pressure her to step down and the entire government to be ousted. Now, nationalist sentiments are running at a high at the moment, and whether this gets out of hand will be a key watch point ahead of the Constitutional Court's ruling on Paetongtarn's future.
So, have we seen any market reaction linked to this crisis?
So far, yes. A new threat of protests is seen, raising risks for military coup at a time when the Thai military is undeniably enjoying greater popularity among the Thai public. And the higher chance of political unrest, as well as risks for military coups, could further rattle foreign investors who have sold more than $2 billion worth of Thai stocks this year. And after fighting broke out yesterday, the Thai benchmark stock index reacted. It extended losses to 13% this year, and today even fell at open. And all of this, of course, comes at a very challenging time for both Thailand and Cambodia, with the U.S. threatening to impose really stiff tariffs in less than a week from now. And it's not looking great, especially for Thailand, which is export-driven, but hasn't secured a deal with the U.S., while its neighbors, Indonesia, Vietnam, the Philippines, have already secured lower rates.
Yep, still waiting. Our Bangkok bureau reporter Patpicha Tanaka-Sempipat there. Thanks for joining us. Still to come, Indian Commerce Minister Piyush Goyal shares why he's confident that India can clinch a trade deal with the US before next week's deadline, averting threatened tariffs of 26%. That story next. This is Bloomberg. Welcome back. You're watching Insight. After 3 years of intense negotiations, India and the UK have sealed a free trade agreement, eliminating tariffs on products ranging from cars to alcohol. Indian Commerce Minister Piyush Goyal says the deal is a win-win for both countries. He also told us he's confident of reaching a trade deal with the US.
I've had some wonderful engagement with my friend and colleague from the US, the Commerce Secretary, Mr. Howard Lutnick, the United States Trade Representative, Ambassador Jameson Greer are both very dear friends, and I'm sure we are looking at a great business with the United States in the years to come.
You've managed to ink some really key concessions, especially on the national insurance payments front. Are you hearing from companies that they want to increase investments in the UK as a result? And if so, where?
Well, I think Indian business is very excited that we've got the free trade agreement in place. We've got the double contribution convention in place. Indian businesses have been very bullish on the UK. And if one looks at the investments flowing in from India to UK, it's a tad more than the other way around. So I think this will also encourage greater investments because of the stable and predictable environment, business environment. It will also open the doors for more robust and resilient supply chains. It will ensure that we can both work as trusted partners, expanding trade in goods, in services. I think Prime Minister Narendra Modi and Prime Minister Keith Starmer both very clearly recognize and articulated today that this is a milestone and historic achievement which will hold good stead as we double our trade, as we grow our jobs in both countries. It's a win-win for both UK and India.
Are any big Indian conglomerates already planning that expansion?
I think we saw, for example, the Bharti Group become the single largest investor in British Telecom.
Yeah.
Clearly a sign that there is trust between businesses on both sides. In fact, they are also a major part of the OneWeb.
Yeah.
We are aware that many pharma companies, many IT companies already have a significant presence in the UK. Companies working on pesticides and chemicals and very many sectors are looking at the UK as a possible center both for goods and for services.
The other talks were, of course, ongoing on the bilateral investment treaty. Can I ask, what are the sticking points remaining on that?
Well,
and
I think
what would
negotiations
you like to see?
happen in the negotiating room. We don't discuss that in the media. But I do hope we will get that also across the hump soon.
And are there any concerns, especially for Indian generics makers, or in terms of dumping from India, that are still there, or have those all been resolved?
Well, in fact, we were being wrongly classified as a country which had any problems with our patent and our IP regime.
Yeah.
We were able to have very, very good discussions with the pharma companies, with all the stakeholders, both in India and in other parts of the world. Concerns that came to our attention which merited any change have been addressed, and which has given a big boost to patent filing, faster clearances. In fact, in the last 2 years, we've done nearly 160,000 patents being issued, so much so that we don't have much of a backlog left anymore. And I think we've been able to create a trusted atmosphere with fast-track clearances. And we now have a robust intellectual property rights chapter, both with Switzerland and with UK. Two countries which always used to be at the forefront of innovation.
It's Indian Commerce Minister Piyush Goyal speaking there to Bloomberg's Ruth David. Well, let's get some insight on India's trade deals with Garima Kapoor, Senior Vice President and Economist at Elara Capital. Garima, thank you so much for joining us today. I just want to start off with the looming deadline of August 1 for India and the US to reach some sort of a trade deal. We heard the Commerce Minister there sounding a note of optimism. Do you share his optimism, or do you think we're going to see a delay?
The recent data points, as well as the news that we are garnering here, seems like there have been certain issues that still remain a sticking point, especially relating to agriculture and dairy and tariffs on aluminium and steel. Yet it is quite possible that a mini deal that leaves out some of these contentious sectors for which there is no agreement as yet can still be struck till August 1. However, the recent developments that have come in give me very little hope that even that is on the card. And having said that, the fact that both these partners, both US and India, negotiating team, have been continuously in negotiations, and now they're on the 5th round of negotiations, offers some hope for sure.
Yeah, let's talk about those sticking points that you mentioned a little bit more. Agriculture, dairy. I mean, from India's perspective, this is about more than money. This is about protecting potentially the livelihoods of hundreds of millions of small farmers who just simply cannot compete with a flood of cheaper imports. So how does India balance these demands of wanting to reach a trade deal but wanting to protect some of its most vulnerable people?
I think the template can be seen in terms of the India-UK FTA that got signed just yesterday. India has managed to get concessions for its dairy and agriculture sector, whereas India has not ceded concessions to the UK for the dairy and the agriculture sector. So the template clearly is very evident that if we have to protect the domestic industry, especially from millions of farmers whose livelihood depends on agriculture as well as dairy, it will become very challenging for India to agree on a deal. However, a mid-part can thereby be applied where India could give greater concessions to non-agriculture and non-dairy commodities, whereby in quid pro quo also commit to greater investments or greater purchases of US nuclear fuel, that is uranium, or basically agriculture products, high-end agriculture products from US, or defense products, and as well as energy products. So if the objective is to reduce the trade deficit between two countries, I think a via medium is still possible that leaves out agriculture and the dairy sector.
Do you see perhaps a similar pragmatic approach when it comes to India's generic pharmaceutical industry?
I think for generic pharmaceutical, it's a little complicated. So in the sense that after the recent One Big Beautiful Bill that US has passed, and the reduction in Medicaid that has been, and Medicare, both that has been executed in the US, I think it can become a little politically challenging for US now to have any tariffs on India's generic exports or pharmaceutical companies. And otherwise, the prices of most of the medicines and regular use medicines in US could really shoot up. I don't think the goodwill factor or the current public appreciation, or I should say the public support to President Trump right now is very favorable, such that he can still manage to garner another impact on the average citizen in the U.S., which would come through higher cost of generics into the U.S. So that looks a little more challenging from U.S. political point of view, in my view.
Is there also a somewhat challenging sticking point when it comes to India's purchases of Russian oil? This is something the U.S. would obviously like to see an end to. How does that get resolved?
With regards to U.S. oil, clearly India has shown intent to reduce its purchases of Russian oil. In fact, large public sector oil marketing companies in India, which drive and which are the dominant refineries in India, have reduced the reliance on Russian oil. And in recent months, we have seen greater imports from U.S. coming in terms of shale oil. So I don't think that should become much a sticking point. And in case that becomes, we really have a counter in terms of being able to depend and import large volumes, both U.S. shale oil, as well as look at certain arrangement when it comes to gas.
Well, let's talk a little bit more about the deal that India's just struck with the United Kingdom, the free trade deal. The Commerce Minister, we heard there, praising that as a win-win. Do you think that's going to provide a helpful template or at least some tailwinds when it comes to reaching some sort of agreement with the US?
To some extent, in the sense, a template where India has tried to protect its sectors, especially agriculture and dairy, could become a template, but we know that's a sticking point and a contentious issue with the US. But what could happen, in my view, as a template, is that India has accorded across-the-board concessions to a large product line coming from US. For example, the average trade-weighted tariff for India, of Indian exports to US, as well as that to UK and vice versa, is now being reduced from 15% to 3%. Secondly, this is the first trade deal where India has offered a concession and opened its auto sector, which otherwise was always very protected. Of course, it will happen in a staggered fashion, but that's a first template and first of a sorts. The deal is also first of a sorts, whereby India has also allowed UK companies to bid for projects where public sector bidding and procurement takes place. So that could be energy, could be relating to, let's say, oil and gas, otherwise. And third and most importantly, I think India's agriculture sector, which had very little presence in UK. For example, UK imports roughly about $37 billion worth of agriculture produce, but India exports to UK under that category is less than $1 billion. There's a similar case in terms of marine as well as processed food. I think these three components have actually got significant concessions. Now, should US agree to this in terms of a quid pro quo for a greater purchases of, as I mentioned, nuclear fuel or defense or energy, I think this could become a good template for us to follow with that of US as well.
Just finally, the two-way trade between the UK and India is about a seventh of what it is between India and the US. But do you still expect a meaningful boost to GDP in India as a result of this deal with the United Kingdom?
The deal with the United Kingdom will boost GDP mainly from the primary products exports as a first leg. The labor-intensive sector, other labor-intensive sectors that benefit significantly are going to be textiles, where India's value chain presence from cotton to ready-made garments is very formidable. And remember, once this deal is into effect, what it does is it puts India on same competitive edge with that of Bangladesh, which enjoys a preferential arrangement with UK, and that of Vietnam, which has an FTA with UK, making India's textile exports very competitive. Other labor-intensive sectors where we could gain also include something like footwear, where India's presence right now is UK is very small, but you do have large players like Clarks, which are sourcing already from India. So net basis in terms of GDP, we could see about 10 basis point impact, but it is important to note that 57% of the product lines for which the deal has been struck will see a zero tariff only after a decade. Mm-hmm. So the impact of the benefit is likely to be more staggered than immediate, as most people expect.
All right, Garima Kapoor of Elara Capital, thanks so much for joining us today. I just want to get you across some of the moves we're seeing in Vietnam at the moment. Most of the indexes around the region a little bit weaker today, but we've got the Vietnam benchmark on track for a record close at the moment, higher by about 1/3% right now. A lot of optimism around this, investors coming back to the market ahead of a possible upgrade by the index compiler FTSE Russell. Some of the biggest gainers in Vietnam Container Shipping, and Chuong Duong, which is a company that offers infrastructure construction services, builds roads, bridges, ports, airports, etc. So plenty of optimism around the Vietnamese stock benchmark at the moment, on track for a record close. Well, up next, South Korean tech giant Samsung also bracing for the potential impact of US tariffs. This is after President Trump threatened a 25% levy on Samsung phones that are not produced in the US. Samsung president, though, Won-Joon told us exclusively that their vast manufacturing footprint could offer strategic advantages when it comes to managing tariff-related risk.
So Samsung has long established multiple manufacturing facilities in key regions around the world. That kind of gives us a flexibility in dealing with or responding to any changes in other countries' kind of trade policies, not just the U.S. So we have established that kind of a flexible system. And in regard to this potential tariff by the new U.S. government administration, there are a lot of still uncertainties.
We have seen that deal that at least brings down the threats of tariffs from more than 40% to 20% for Vietnam, which is a huge manufacturing base for Samsung. How do you see the developments and how much of a benefit could that be? Or does it still hurt because it's still higher than it was originally at average 3%?
These new tariff policies obviously are very challenging to us in terms of business. And the mention about the Vietnam, obviously the lower the better, but also as I mentioned, we do have multiple locations, multiple manufacturing capabilities, and over the past few months, we've been working very hard to make sure the products that are bound to U.S. can be manufactured in any of the locations, not any, but in multiple locations. So depending on, so we're looking at the Vietnam, but also we are looking at Korea, India. I mean, what will be the final tariffs? So as I mentioned, we're going to just do a lot of optimization according to the final numbers, but the lower the better.
Is that easy to adjust production?
That we have been working very hard to make sure once you make that decision, that can happen really quick. So we've been doing a lot of preparation.
That's Samsung President and Mobile Experience COO Won-Joon Choi speaking exclusively there with Bloomberg's Sherian. Well, we've just had markets in India open. Let's take a look at how we're tracking at the moment. Seeing a little bit of weakness, which echoes what we're seeing across the broader Asia-Pacific at the moment. The Sensex off by about 1/3% right now. No tailwind really from the signing of a free trade agreement between the UK and India, which the Commerce Minister hails as a win-win. So a little bit of weakness in Indian markets at the moment. Still to come, Liverpool Football Club getting set for their upcoming season with a series of games in Asia. We'll hear exclusively from their CEO next. This is Bloomberg. English Premier League champions Liverpool FC have arrived in Hong Kong to kick off a series of pre-season friendly matches. While the club enjoyed great success on the pitch this year, it's also still mourning the recent deaths in a car crash of star player Diogo Jota and his brother. We spoke exclusively with the club CEO Billy Hogan about how the organisation's coping while looking ahead to the season ahead.
Obviously, it's been an unbelievably difficult last couple of weeks since Diogo and Andre's passing. Obviously devastating for all of us at the club, even more so, of course, for his family. And so, we're here in Asia on tour, but we're obviously staying in touch with the family, and we'll be remembering both Diogo and Andre before the matches while we're here in Asia. And then, of course, when we get back to the UK, and talking to the family also about a more permanent tribute that we will have in time at Anfield as well. But just devastating, of course, and just tragically sad. He was just obviously a really gifted footballer, but a terrific person, and he's deeply missed.
There's never going to be a perfect segue from something as tragic as this. I guess to the point, just to underscore, certainly big shoes to fill on the field, and that takes us into really what's been also busy on your end this recent weeks. The transfer window's quite been busy, and you guys, I think what stood out to many of the fans and many people who follow the club all over the world is suddenly the financial resources are there to be able to bolster the club on the pitch. Give us a sense of what's changed and why suddenly this big, just a massive amount of activity in this transfer window?
There was equal noise last summer in the fact that we didn't spend very much, and so look, our perspective is that we're always trying to improve the squad. That's the most important thing that we can do. Certainly from a football perspective, the focus is on competing, winning trophies, putting the club in the best possible position to do that.
There's always been, because of the business you're in, the speculation of the commitment of the owners, longer-term commitment of the owners to the club. And I wonder if you could comment on that.
Winning the Premier League, having won a number of trophies over the course of the last 7 or 8 seasons is proof positive that we're going in the right direction, but there's absolute commitment from ownership.
Yeah, well, that's a good reminder for me to not follow certain punditry. Let's put it that way. Well, I think do you think the amount of money that's been committed to bolstering the capacities of the team on the field, should that address some of those concerns?
Sometimes those investments look outsized in relation to other transfer windows, but again, it's all done from a strategic standpoint, and it's always done from the standpoint of trying to do what's best for the club at the end of the day, what's best for the club in the near term, and what's best for the club in the long term.
Now, let's talk about the business.
Sure.
Priorities this year. Let's talk about the next 12 months. What do you want to see?
I would say on the business side, sort of more of the same. The retail side of our business is growing exponentially. We're just about to open our 20th standalone retail store, which is more standalone retail stores than any team in the world of sports. And we're partners with all-star partners here in Hong Kong and across China.
How far along are you in the planning there, in terms of the Japan store, by the way?
It's something that, from our perspective, we look at each individual market based on its merits. And in the case of Japan, we have a significant following there. And so really it's about finding the right partner.
The future of streaming, I want to get your sense of how you're looking at that as an opportunity. Is that something that's feasible right now within the near future? So
from our perspective, ultimately the Premier League controls all of the broadcast rights.
What's the hope?
Yeah, so I think, look, we're in an evolving media market, clearly. We'll see that over the course of the next, I would say, decade or so as the media continues to shift from what was previously sort of linear to now what is more of a streaming concept as well.
In terms of the transition from Klopp to that could not have gone better. And so the question I have is, and this is something that a lot of CEOs deal with in terms of succession planning. How do I replace a top performer with another top performer? Any advice on how to be able to do that?
Part of that is about planning, part of that is about strategy, and part of that is having the time to get the right people in place. Being a manager or head coach of a football team is a little bit more difficult because typically you don't have that run up. But in our case, we obviously did, and as you said, it couldn't have gone better.
Liverpool Football Club CEO Billy Hogan there, speaking exclusively with the China show co-anchor David Ingles. Before we go, here's a preview of our shows next week. We'll discuss market strategies with market veteran Ed Yardeni and also JPMorgan's Joyce Chang. And that is as we await key central bank decisions from the Fed and the Bank of Japan. International trade policy expert Maisel Consul's also going to join us live as we count down to President Trump's August 1 tariff deadline. Also, we'll get a pulse check on the property sector with JLL's Pamela Ambler. That's all next week, but for now, that is it for Insight. Horizons Middle East and Africa up next. This is Bloomberg.